It's been a fascinating week of commentary, especially out of the NABE conference. You got Mester on one hand saying it's unclear how cutting rates would actually help spur the economic engine again. You got Coach Lakota, your former colleague, saying let's do a 50 basis point insurance cut now. Where is the answer?
Well, Coach Lakota is no longer at the Fed, just as I'm no longer at the Fed. So the real question is, if this is a supply shock, what good would a rate cut do, particularly the rates that affect businesses, operating businesses? The 3-month is still inverted as you go down to the 10-year, which is trading near the lows of July of 2009. The intraday low was 132.13, as I recall. So we're getting there. But if you look at the 2-year, the 5-year, the operating cost monies for corporations, money has gotten cheaper, not more expensive. So the question is, what impact would this have? And the answer is, it's doubtful. So, and then you have to also ask the following. If this is indeed a real black swan event, and just so you know, I nickname it because coming out of China, a red swan, then you want to have some money left in the bank. You've got to have some action you can take, and there's not a whole lot of coins left in the Fed's pocket. So you're going to spend those coins very carefully. I've said this many, many times since they started cutting rates. They're going to be cautious unless they see an impact on the real economy. The Richmond Fed survey isn't as powerful as the Philly Fed survey, which is fairly strong. And the anecdotal reports you're hearing from corporations all have to do with supply chains. And I'm not clear what a Fed cut of the Fed funds rate would do to sort of goose those supply chains. You really can't solve this problem in that way.
Sure.
So I would not be advocating for a cut here.
Right. The second point of that argument is that while it might not help, it might also increase the imbalances that at least Mester criticized yesterday. You agree with that?
I do, and I thought the commentary earlier about how, and again, this is just a personal observation. This isn't the view of Barclays or any other firm that I'm associated with. As was said just now in the previous segment, this market was very bullish, very richly priced, and a tripwire could offset that. I'm worried about a couple things, by the way. First, on China. The best analysis I've seen comes from Willie Shih, who's a professor at Harvard Business School. It's worth looking at and getting him to talk about this because he understands the internal dynamics within China. He's been talking about this for quite a while, and it really is messing up the entire system. The tripwire then goes to Japan. We've seen their export numbers are awful. Singapore, Vietnam, even Taiwan. So it infects the whole area right around that, and that in turn affects and infects the different supply chains that build upon that, an input into an input into an input. So I wouldn't discount this as having no effect on the real economy. I think it will have a significant effect on the real economy. Relatively speaking, as pointed out earlier, we in the United States are comparatively in very good shape. And I think that explains perhaps where the 10-year Treasury is trading, because it's a flight to safety. It's money that comes here in a world of negative yields and not very attractive economics in Germany and elsewhere in the European sphere, certainly not in the Asian sphere. It drives our rates down. And so the question is it signaling a recession here? Or is it just sort of a flight to safety? And that needs to be debated fully. And that's what would lead me to conclude at this moment that the Fed really can't do much here. Besides that, operating business rates are down. So we'll see.
On the flip side, Richard, though, I mean, it's not just a supply shock. There's also a major demand factor here, both in China and around the world. If we start to see consumers pull back, airlines, restaurants, these are all services as well that get impacted. And then, you know, if you look at growth slowing globally, that does trickle into the United States. And if we are looking at lower growth and lower inflation rates, then the Fed can come in. It has room to cut rates. We've seen that. We saw it last year.
That's true. And the question is, what was the efficacy of those rate cuts? The one thing it did affect was, of course, where stocks and tradable assets trade. But did it really have an impact on the real economy? Highly debatable.
Well, they got the yield curve uninverted, and they got talk of recession sort of out of the mix. And, you know, the stock market does have an impact on confidence, doesn't it?
It does. You know, obviously, the manufacturing sector has been suffering. We've known that all along. The goods sector has been deflating, by the way, all the way back. Prices in goods deflating all the way back to 1986. The service sector has been where whatever counter pressures there on prices has been coming from. Consumption has been strong. If you have a crisis of confidence, and that's what we could have here, then you're absolutely right, Sarah, it can impact consumption. But at the same time, we're fully employed. When you're fully employed, you consume. Savings rate is high. So there is some cushion here from the consumption side of our economy, and the fact that we are less interdependent, although we're still interdependent, less interdependent than other people, and that leads to people directing their capital into our markets, into our fixed income markets for safety, and that's a boost for anybody that needs to borrow money. So there are counter influences here. I think we have to be very careful in analyzing this, and the great thing about the Federal Reserve is they're extremely thoughtful in the way they look at things. They take their time. They don't react on a shoulder jerk fashion. And I have great confidence in the FOMC and especially in Jay Powell.
Speaking of Powell, he's repeatedly mentioned concerns about leveraged loans. We've had Kraft and Macy's get cut to junk. Rating agencies are clearly on the case, if you could argue. I wonder if we are getting closer to the locus of his concerns on that front.
Well, as you know, the spreads had narrowed dramatically, particularly for junk over investment grade. They've widened a little bit, but yeah, that's of concern. The debt loads are high. If rates were to rise or inflation were to come back, that would lead to great concern. And I think he's just really highlighting these kind of knife-edge threats to financial stability and just saying we need to be cautious. By the way, he's been at the G20 meeting in Riyadh, so I haven't heard from him lately, but we haven't heard from him lately. But I think he's just pointing out that, things are almost priced to perfection. You get an upsetting event, whether it's a severe black swan or a red swan or whatever it is, and that can upset the balance.